we are following same basis. You see, it's format based only, the content are all studied already, Okay, so I've actually gone through these common items, the 6 common items, to see whether in this question, are there any of these 6 common items, and we have detected, oh yeah, got depreciation and donation, which is what we have written down, okay? Now, once you have identified the 6 common items, from now on, you're talking, you can't finish then how, right? Okay? Now, after this, what you're doing is you're putting all these expenses into this model to check on the deductibility. Now, I've already told you deduction of expenses is an extremely important topic. Okay? Very important topic. What should you be preparing for? You should also be preparing for theory questions pertaining to that topic. You follow me? Alright? Which I've, I think, repeated so many times. Meaning, must go through your text. See, your two, what do you call that? Textbooks are important in the sense that when your examiner sets questions, right, he's very fair. He follows these topics that are, and the examples that are given in this textbook, like Bible, like that. Alright? Okay? So therefore, be familiar with the examples as well as case laws which are discussed. Okay, especially for topic on deduction of expenses. So given a scenario, you should be able to know, oh, okay, based on this scenario given, right, remember, I'm not leaving up right to the end to discuss on the important issues. As I cover the segment, I will talk about it. Okay, so now that we are on the topic on deduction of expenses, when you study, which we have already gone through the extent to which you must focus on, when you take a look at your Singapore Master Tax Guide, please go through the case laws that are identified there. Alright? Plus, you must also be familiar with whatever Mr. Mike Curran has uploaded for you in the Canvas. Remember the first step that he has actually uploaded for you. Any case laws, he has already said, will be either from there or from the Master Tax Guide. Okay? Alright, be familiar. Let's say you're given scenarios, you should be able to know, okay, if it is a repair that is actually being carried out, is this a repair which is a pure repair, or is this considered as an improvement? Follow me? Alright, now why is this important? Again, last week I highlighted to you, improvement, no deduction. Okay? Pure repair. Now what do I mean by pure repair? It must not be an initial repair. Because if you classify and it comes under initial repair is also capital expenditure. You okay? Alright, so you need to distinguish this. So once, if it is not an initial repair, and if it is deducted by the accountant, then correct, I no need to do adjustment. Otherwise, I have to add back in my tax com. Okay, so these are the things that you are actually looking at when you are going through the set of information that is given for you. So, looking at this set, okay, I'm looking at, okay, shop rent, and there are no notes given. So, no notes given means you must always remember a business is carried out in order to meet what is the nature, in other words, what it originally meant for, meaning, well, they need to pay this rent in order to operate their business. It is incurred in the production of income, no problem, deductible. Okay? Now, for purposes of doing this question, if it is deductible, I'm not going to write down shop rent and put 0. Is that okay? But in the exam, please read the question. If the examiner, alright, when you read, information will be given under the required, very clearly. That means he will say, you need to record all the expenses and all the income, alright, whether or not it is deductible or not deductible, okay, because marks are allocated. So if something like that is given, that means I will write down shop rent 0. You follow me? Okay? Why? Because if you don't write, whatever marks allocated for that will not be given, even if your final answer is correct. Is that okay? But I'm not writing down so that we can finish the question faster. Okay? Alright, now next one. Utilities. Again, nothing mentioned. I will take it that all these are incurred for the normal cost of carrying out the business, deductible. Now, staff salaries, no problem, right? Okay? Why? You need the staff in order to actually carry out your business. So incurred in the production of income, deductible. But look at these two people. These two people are partners. Partners are owners of the business. Remember, we already said partnership, sole proprietorship, not separate legal entity. The owners and the business are considered to be one and the same. So this is considered as appropriation of profit, and we will need to add back this. But remember, my first part is to compute divisible income. So whatever I'm going to add back now, right, must belong to the partners based on profit sharing ratio. So IKID. Okay? Alright? So this one I don't add back yet. Depreciation, we've already added back. Now, interest on capital. Now, information is given here. I will take it that you have already gone through this question. Okay, so I'm going a little bit fast. If anything you don't understand, you can always ask me later, no problem. Okay? Even if there is a class, I'm not sure whether there's a class later. If there is, then we can discuss outside. Okay? The lecture room, no problem. Okay, now, you see, this is additional notes pertaining to the interest on capital. You follow? Now, this additional notes is telling you, since I will take it that you've read, what does it say? It is actually telling you that these two partners, this is the capital that they have contributed towards the business, and they are given a 5% per annum for this capital that they have contributed. Now, therefore, immediately I must know this is like drawings. You cannot give interest to the money you contributed into your business when the business and you are one and the same. Therefore, this is considered to be like drawings. An appropriation of profit, I need to add back. Again, I will add back later. Why? Because how much each partner gets, right, is dependent on not the profit sharing ratio, is dependent on what is the capital that they have contributed. So this is what we mean by allocation on actual basis. Okay, it will be clearer as I go through the entire tax com. Okay, so again, IKID. Now then, when I turn to the next page, right, the next page basically gives you a list of what are the expenses, other expenses, what is the breakdown, right? That is what is given to you on the next page. So let's go through that one. Okay, so it tells you, okay, let me cover so that you are not unnecessarily distracted by other information. Okay, now looking at this, right, okay, so you need to now analyze. Okay, my other expenses comprises of all these items, and you decide on the deductibility. Now remember, when we did the topic 3, which is topic 4, deduction of expenses, at the last few pages I've already told you there are 2 pages which list out for you what are expenses which are deductible. 2 pages list out for you what are the expenses that you will commonly see, which straight away you know it is not deductible. Be familiar with that so that not for every single expenses given, you need to think along this line. You know what I mean? Because if for every single expense you are going to think along these lines, it's going to take up a lot of time. So you must be familiar with some common expenses which are deductible and non-deductible, which is there for you in your notes. Just go through, okay? And again, study that topic on deduction of expenses. That one is super important, okay? Now, looking at that, with that in mind, whatever we have done, you are looking at this expense incurred, you need to decide on the deductibility. So what will your answer be? Is this deductible? So again, you must go back, revise. Immediately you must know, yes, deductible. How do I know? Because it says renewal of tenancy. Instead of renewal, if the question says new tenancy, then immediately you must know not deductible. You follow? So yes, this is deductible. Now remember what I told you, if it is deductible, I'm not writing down. Okay? But in the exam, if the examiner says, well, if it is, whether it is deductible or not deductible, you need to write down, then you write down to 0. Okay, next one. Installation. Is this deductible? We have gone through. What is this? This is considered as part of capital expenditure of that item. Okay, so therefore this is not deductible, I need to add back. Okay, this is not a revenue expense, it is a capital expenditure, so I'm actually adding back. Okay, so since I need to add back, right, I'm including this item. So remember, okay, just for your information to make it easier for you, okay, I just write these two items, which is like what? The shop rent. Alright, okay, shop rent, I'm writing 0. Why? Because it is deductible. Okay, utilities we have gone through. Again, we have explained that this is incurred in the production of income, alright, and therefore it is a revenue expense deductible. Okay, after this I won't write any more items, okay, so you just take note, okay, so that you use this as a framework, okay, when you are doing your question. Okay, now we were talking about installation. Okay, installation of aircon. Alright, now installation of aircon. You know, this is not a revenue expense and therefore effect. Okay, now next one. Next one, loan to staff written off. Now remember, again, so immediately you must know what are the things that we have learned under section 14(1)(d). Now we said to be deductible, it must be a trade debt. And I've told you there's only one kind of trade debt, which is you give a credit sale to the customer and the customer never paid you. Okay, and how do I know it is a credit sale? If you don't know, always ask. You want the accounts already, right? You must ask, what is the journal entry? Okay, to be a trade debt, the journal entry is debit the debtor or account receivable and credit sales revenue. This transaction must be there. If it is any other transaction, immediately you must know non-trade debt. Okay, so therefore, yes, this is a non-trade debt because you will never be given a question about specialized industries like banks, shipping, all this you will not be tested on. Okay, so therefore immediately I must know, okay, out. This one is a non-trade debt. So non-trade debt, accountant has allowed it as a deduction. What do you do? Add back. Okay, so loan to staff. Okay, written off. Alright, loan to staff written off. Add back. You follow? Okay, now let's go on. Let's go on. Okay, this one. How about this one? Business trip by John. Remember, John is a partner. So how? Is it deductible or not deductible? John is a partner. So will it be deductible? Of course. If not, nobody wants to start any business, correct or not? Okay? Now, it is only not deductible if the expense is for his own personal use, right? Private purpose. But this is for business purpose. And therefore, no problem. Yes, it is deductible. Now, always remember in deciding, right, whether or not it is expense, is it deductible or not, you are literally going through the principles that we have learned when we actually gone through this model when we did your topic 4. Okay, that means you're always asking, hey, when I say deductible, right, number one, you are checking, is it a revenue expense? Okay, so in order to again determine, hey, is it a revenue expense or not, what are you going to do? Follow the guidelines. Okay, follow the guidelines. And I've told you one of the important, a guideline that really helps you is ask yourself, when you look at a transaction and you're not sure, ask yourself, is this an expense which is recurring in nature? Okay, usually it will help you. Recurring means what? Is this one which will happen again and again within a short period of time? If your answer is yes, this is a recurring expenditure, normally revenue in nature. If your answer is no, it is a non-recurring transaction. Okay, it happens once in a way. immediately you must know it is a capital expenditure. You okay? So at that point itself, the minute you know it is a capital expenditure, your answer will be, okay, no, here, right? Capital expenditure and therefore not deductible. And the minute you say not deductible, you must know how the adjustment is to be done in your tax computation. Once you say this is, yes, revenue in nature, then move on. You should, because if the examiner asks you, state why is it deductible or why not deductible? And if the answer is yes, it is deductible, you must know it must comply with the 3 criteria. It must be 1, a revenue expense. 2, it must be incurred in the production of income. Okay? And that means the examiner asks you, right, state why is it deductible. You can always say it is deductible because it is a revenue expense and it complies with section 14. That is, it is incurred in the production of income. You see what I mean? So this is how you support. Now, how much you need to write, right, for a certain expense or certain scenario given will depend on the marks allocated. You follow? So, if there are more marks given, after stating this, what will you do? Look at, is there any case laws similar to the scenario given and use the case law to support. Okay, so this is how you will answer questions. Now, and of course, after doing this, remember, this is not foolproof. What must I do? Check my section 15. I've already gone through section 15 in the notes, right? That's about all you need to know. For section 15, only those handful. The minute you say this item is caught under section 15, immediately you must know section 15 overrules. You okay? So your answer would be something like, yes, it is a revenue expense. It is incurred in the production of income, however, it is prohibited under section 15 and therefore not deductible. You follow? So this is how you will be answering questions, okay? And where necessary, please remember to quote the relevant sections and case laws. Okay? Examiner will ask you. Alright? So substantiate with case laws. Okay. So that's what basically you're doing. So naturally, for business expense, no worries. Your answer will be yes, deductible. It is incurred in production of income. Okay, next one. What about this? Fees for preparation of partnership return. Now remember what I told you, right? They tell you anything about partnership tax return, immediately I must know. Okay, I'm referring to Form P. Anything to do with Form P, deductible. Okay? Next one. Christmas gift for customers. Okay, again, anything for customers. Alright, it is actually to promote your loyalty, customers' loyalty to you guys. Therefore, incurred in the production of income, there's no problem, deductible. Next one, they already tell you allowable expenses. Okay, so examiner already tell you allowable expenses means he's helping you. There's nothing for you to check at this with regards to this. So that's it, all finished. Okay, this entire component finished. Now, let's say, for example, I see loss on sale of equipment here. Now, what will I do? So, immediately you must know a loss on sale of equipment, okay, is it a revenue expense? No. Okay, so if I see anything like that, then I add back on. So, you see, I will just write. So, you see, I use another different color means there's nothing to do with this question, okay? So, loss on. Okay, if it is a sale of equipment. So if the accountant has included this, then remember I must take out. Okay, so accountant has added, has actually included this as a deduction. I'm adding back. Remember, you add back all the non-deductible items. Okay, now if let's say instead of a loss, okay, instead of a loss, I'm looking at my question, right? Okay, and I see below the gross profit, I see one item, profit on sale of computer. Okay, So what is the accountant doing? He takes the gross profit, he adds the interest received from the bank, and he also adds the profit from sale of computer here. You have to decide. Accountant, when he has, that means what he has done is he has increased the profit. Is this a revenue receipt? You have to decide. And again, all this we have already done in your first lesson, the initial part itself. We have already said when it's receipt and you're not sure, you need to know choice, go through the guidelines. And going through the guidelines again, you will know profits received from sale of any fixed asset is capital and therefore non-taxable. An accountant has included. So what will you do? You need to do adjustment. Okay? So where will I adjust? Your choice. If you want, you can actually less out here itself, but then you must be very vigilant later on that you pick up only the other income and consider the taxability, or you can put it here. Okay? That's why, remember, we say add or less. So personally, I always like to just leave my other income very clean, so that later on when I do, I will just know that I only need to do adjustments pertaining to this. But I leave it to you. It's your choice. Okay? So when it comes here, less, okay, at this point, you must know these are not taxable, but accountant has included it. And therefore, I take out. So I will be writing, okay, let's say, profit on sale of computer. Okay, now this one is not taxable, but accountant has included this as part of his profits, and therefore I take it out. See what I mean? Like that. So this is what we mean by adjustment, and the adjustments that you're doing will be the same. The way you actually analyze in order to decide on the deductibility or non-deductibility will exactly be the same, whichever business entity's tax form you are doing. Okay, so my subtotal, okay, is so much. Now, my description. Now, the description, remember, I'm doing for partnership. Now, this subtotal is what we refer to as divisible profit. Okay. Now, what do you mean by divisible profit? Divisible profit simply means whatever items I have adjusted, okay, that means add back or less. Whatever that has been adjusted belongs to both the partners or all the partners, whoever are in the partnership concern. It is going to belong to them all, and they are going to share it based on their profit sharing ratio. So whatever items which belongs to both partners and which is going to be shared based on profit sharing ratio, and I'm doing adjustment on all those items and getting my subtotal, it means this is my divisible profit. So later on, I will just need to take this subtotal, right, and divide between the partners based on profit sharing ratio. I no need to consider what has been included, okay, in order to derive this. Follow? That's basically what we are adding back or deducting in order to get the divisible profit. Now, after that, remember, in any tax form, I must calculate what is my adjusted trade profit one. Okay, so in the case of the partnership, right, how do I derive? So after this, right, I'm going to add back all their appropriations. Okay, now, appropriation means what? The drawings. So what are the things that are specifically applicable to the individual partners, meaning nothing to do with the partnership, nothing to do with the profit sharing ratio. Okay, so you see the salary. How much John gets, how much James gets, has nothing to do with the profit sharing ratio. Okay, it has this one, it has to do with the partnership agreement. This is what we mean by allocation on actual basis. So remember, this one is drawings, therefore I add back. Okay, I add back so much. Okay, now what else? Remember, we've already said interest on capital. Now this interest on capital, remember again, the 6,000 is drawings. Why? You the partners cannot be contributing interest, cannot be charging the business interest on the capital that you have contributed. Okay, because you and the business one and the same one. So therefore, this again is an appropriation of profit. Okay, 6,000. Now notice at this point, I no need to identify and give a breakdown of how much belongs to John and James, because I'm looking at it from the totality of the business, okay, from the view of the business in deriving my adjusted profit or loss. Okay, now as far as this question, right, nothing else. But let's say I'm looking at the question. Remember, whatever we are stating is actually given as part of the profit and loss statement, okay, prepared by the accountant. So let's say, for example, I'm looking at all the other expenses and I see, all right, after this, right, I actually have one more expense. Let's say fees for the preparation, instead of partnership return, I see fees for preparation of John's tax return, Form B. Now immediately I must know, okay, not allowed. Who is the beneficiary? John, not James. You see, it benefits John, and therefore it is an appropriation of profit by John. So where will I record it? I will not record it here, because if I record it here, I'm saying that this expense is belonging to both James and John. You follow? So therefore, I will be adding back here. So what will I do? I will say fees. So remember, whatever I'm writing in pink means has nothing to do with this question, but I'm giving it to you as a format, okay, for the partnership computation. So fees for, let's say, John's tax returns. You follow? Okay, John's tax returns, and remember, this is Form B, you must know, it's not Form P, Form B. Okay, add back. Whatever amount that is paid by the partnership will be not allowed. Okay, now let's say what else. Let's say, for example, I read on and I see, okay, the business has actually paid the insurance premium. Okay, so they say, let's say, for example, life insurance premium paid for James Life. Okay, and remember, and the beneficiary is James' family. Then again, immediately you must know. Okay? Now allowed. Where will I add back? I will not add back here, because if I put the item here, it means both James and John has a share. You see what I mean? But this one is only benefiting James, and therefore I will write it under appropriation. Follow? So I'll be writing it, okay, life insurance premium. Follow? Okay, let's see. Add back on. So let's say, for example, I also see another item, a wedding gift, which is given to John's sister. Now, who is the beneficiary? John. Alright, John, right? The wedding gift is given to John's sister. So, the relationship between the brother and sister flourishes, okay? I mean, doesn't benefit James. Correct? Unless James is the bridegroom, he married the sister. Correct? Okay? So you see what I'm trying to say? Whatever you're writing here should only benefit one or that particular partner. Has nothing to do with the profit sharing ratio. Then you will add back here. Okay? So let's say I say, wedding gift. Okay? like that. Alright? So like this you will analyze whether this item, does it belong to both the partners? If your answer is yes, then you will add back before deriving your divisible profit or loss. Okay? Why? Because both of them has a share in this, and it is going to be divided based on the profit sharing ratio. But if it is only going to benefit that particular partner, you will add back after appropriation. In other words, it will be considered as an appropriation, and it will be added back after the divisible profit. So in other words, whatever you're adding back here, you notice what you're doing? Whatever you're adding back, you will be giving it to the partner based on actual basis. Nothing to do with profit sharing ratio. Okay, so that's it. And now when I get my subtotal, okay, I get this, and this is your adjusted trade profit. Like that, no? This is how you derive. Now, why did I say this is a shortcut method? Remember, if it is a shortcut method, what am I doing? What are we doing? We calculate divisible profit first, followed by adjusted profit. Now, what is the difference between the shortcut method and the longer version? It is just that in the case of a shortcut method, the longer version, I will not write this. This entire line, I will not have. Okay? I will not have this. I just add, and get this one first. After getting this right, I must derive my divisible profit. Now what will I do? Now I will repeat this entire portion here. I will now say, alright, I will now say less, instead of add, right, I will say less appropriation and copy paste this here. You see what I mean? And then my subtotal will give me this one, and then it's divisible profit. You see what I mean? So this is the difference between the longer version and the shortcut. Alright? So that's why I said it saves you time to use the shorter version. Then of course you must, if you ask, right, hey, then why have the shortcut? Like last week I've already told you, there are certain scenarios where I cannot use shortcut. No choice, I must do longer version. Okay? In order to derive my divisible profit. But you, as far as your exams are concerned, will never be given that kind of scenario. As far as you are concerned, if any question is tested on partnership, it will, up to you. You can either do longer version or shorter version. You see what I mean? Therefore, I'm not going through that specific scenario whereby you can only use longer version. Is that okay? So you can adopt this as far as your exams are concerned. Done? Okay, so that's your first step. So you see here, what are you doing in order to derive your divisible profit? I'm adding back or adjusting all those items which belongs to all the partners. Okay? If the item belongs to all the partners, then I will add back here. Why? Because whatever I am adding back here will be shared between the partners based on profit sharing ratio. But if the item only belongs to a certain partner, that means it doesn't benefit the other partners, that means I will add back after divisible profit, and I will bring this item to that individual partner on actual basis, because it doesn't benefit the other partners. So anything which is not to be shared based on profit sharing ratio and not allowed as a deduction must be added back after divisible profit. That's the rule. Okay? Alright? So doing this, what you have done is you have actually done part 1 of the question. Okay? Now remember what is part 1 is to do or compute divisible and adjusted profit. Okay? Now, if it is any question on partnership, it will always come with this and this. And what is this one? Profit allocation. In other words, this is what I'm going to do now. How do I share this profit between the partners concerned? Okay? So let's do that first. Okay. So now I'm doing the part. Okay, remember this one is part 1. Okay. Now, part 4 is profit allocation. Now, remember again, as I told you, your principles, like whatever we have done, right, is exactly the same, regardless of which year of assessment that you are doing. So, not to worry. Okay. Now, the next one we are doing is profit allocation schedule, the part 4. Okay, and like I said, the methodology, exactly same. We are doing YE 2010 because that's what the question is asking of you. Okay, done. It is because yours is open book, right? Examiner expects you to know how the tax system has evolved. Okay, because yours is open book. Alright, but like I said, not to worry because no change. There are no changes as far as format is concerned. Okay, done. Now, first thing I need to find out from the question, what is the profit sharing ratio between the partners? Okay? So what is the profit sharing ratio between the partners? When you look at the question, it actually already tells you. Normally the first paragraph will list out for you. 3:1. Okay? So that is what I'm writing down. Okay? Profit sharing ratio, 3:1. And the partners' names. John has 3 parts compared to James. Now, although no marks normally is allocated to the total column when presenting this profit allocation schedule, it is always good to have the total column, okay, for your own reference so that you don't make any mistakes, okay? So how do we start? Very easy. The minute you have done the first part correct, the second part is super easy. Why? Because you start from here, alright? Because you know already what, this total I need to just divide between the partners based on profit sharing ratio. You start from here and then you continue on until you reach here. So, you know, all this becomes your total column. That's all. Then you just apportion between the partners. So let's do so that means I start with my divisible profit. Okay? So divisible profit. Okay, divisible profit that you have calculated. And because it is divisible, that means what? Share between the partners based on profit sharing ratio. Like that. Okay, done. Now what? Done? Remember what I told you? Just follow. After that, whatever given. Okay, got partner's salary. Okay. So, partner's salary. Now this one, 54,000. Now again, this time round, remember, it is on actual basis. I'm not going to take 54,000 and apportion between them based on profit sharing ratio, right? Actual basis. How much is the actual basis? It is given to you in the partnership agreement, okay? John so much, James so much. Okay, this is what we mean by actual basis. Okay, so that's basically what I am recording. Okay, followed by the next item, which is interest on capital. Okay, so again, from the total column, I got this value, and how much John gets and how much James gets, like I said, will depend on their capital contributed. Nothing to do with the profit sharing ratio. I take this capital, multiply by 5%. All right, and that's how I get these figures. Okay. Okay, done. Now, as far as this question is concerned, that's about it. But remember, we have added hypothetical examples, right? Okay, so what have we added? We have added preparation of John's tax return. Okay, so how will I flag it in the computation? So I will be writing, okay, you can write the description up to you, no worries, okay? You can write preparation for John's return, or just simply write, okay, fees paid for Form B. The minute you write Form B, the marker knows it is individual tax return, and you are supposed to know that as well. So what happens? The total I will write here, but this one, who is the beneficiary? John. So the entire amount goes into John's column, like that. Okay, this is what we mean by actual basis. Then life insurance. Okay. Life insurance, so again, subtotal, the total column, whatever figure that you have indicated here goes inside the total column. But who is the beneficiary? It is James who is the beneficiary, not John. Therefore, entire amount, you will write it under the James column. See what I mean? This is what we mean by allocation on actual basis. And finally, profit on sale of, this one, wedding gift. So you see again, who is the beneficiary? John. Okay, so therefore, I will write down, so same thing again. Right, wedding gift. John is the beneficiary. Like that. Got it? Okay, that's it. So dependent on what are the items that you are adjusting for, you just record it accordingly, and notice you will now derive your adjusted profit. So that's what I meant when I said, once you have done this one correctly right, no problem with the others. Because this entire segment will become the total column for you, and using that you just apportion. That's all. Okay. Now, of course, when apportioning, do not make this error, which sometimes students make. Cannot take this and divide based on profit sharing ratio. So do your calculation vertically, and you should have no problem getting your adjusted profit. Okay. Yeah. Okay. Now done, after this everything is as per what you have actually done with regards to any other tax computation. Okay, meaning say what? So after adjusted profit, what comes next? You will now record the capital allowances. Remember our format is really very much the same. Okay, the minute I'm deriving, you see, your adjusted trade profit, after that, this segment, whatever you've learned under topic 5 comes in. Okay, so you are going to record what are the capital allowances. So again, less capital allowance. Now, for this one, remember I've already told you, your model answer is already given, okay, behind the topic on that question, Mr. Warwick, right? Okay, so let's very quickly go through that. Okay, Okay, let's see. So remember, I asked you to go through that question, right? Okay, let me just take out the answer, and very quickly I'm going to run through the answer scheme with you, okay? So that you can understand. So just give me a minute. Alright, come, let's just go through this. Now, all the information in order for you to do this question is here. Okay? I've already gone through, I'll ask you guys to go through this now. The highlights already tells you in the previous years the company was doing it under section 19(1) and 2. So remember, capital allowance, you must go through whatever we have actually learned in our topic on capital allowances. Your job is to take a look at the question to decide, hey, how are they claiming capital allowance under section 19 or 19A? First step, right? The minute you know they are claiming under section 19, that means I'm going to calculate, initial allowance, annual allowance. Okay, if it is under section 19A, that means I'm going to calculate capital allowance under either 1 year write-off or 3 year write-off. And of course, all the rules, regulations, everything you must be familiar with. Okay, now with that in mind, they are telling you they claim in the past. But from the current year onwards, they want to claim maximum capital allowances. What does that mean? That means, you see these two assets? Alright? These are pertaining to their past acquisition. Okay? And they are claiming maximum capital allowance for the current year purchase, which is computer and motor van. Right? As well as, look at this one. This is your capital in P&L. They included the purchase of aircon as part of their profit and loss expense. Okay? And you have added that just now. Remember? You have added back. Right? So once you have added back, it is your reason for adding that item back into the tax form was it is a capital expenditure. That is why you added back. Alright, but this item is eligible for capital allowances. So all that in mind, okay, let's see. Now, with regards to these first two transactions, right? Okay, with regards to this, now remember format I've already run through with you, so I'm not going through that. Just very quickly, just the numbers, okay? Alright, now with regards to these two, I've already told you, you look at the question and it mentions about tax written down value. Then it's very simple for you. Tax written down value given, I copy paste this as tax written down value brought forward, which is what is happening here. Tax written down value brought forward. Okay, but you see, this question did not tell you what is the useful life of the asset. Agree? Therefore, you need to know what is the useful life. They are using section 19. Remember when we did the topic on capital allowance, already given you the key, what do you call that? The key items, all right, and the relevant useful life. That means I've told you, just looking at the item, identify. This one, is it an equipment or furniture? Alright? Or heavy machinery, blah blah blah. So you see, heavy machinery, plant machinery, examiner will outright list it out for you. Okay? So this one is an equipment. And if it is an equipment, what is the useful life of the asset? 8 years. So the item has 8 years. Then you have to decide. The year of purchase is 2006. Now this partnership, looking at the question, is closing their books when? They are closing their books in December. Okay, they are closing in December. So that means it's easy for you. They are having calendar year as their year end. Okay, so if I tell you that this asset is acquired in the year 2006 and it has 8 years of useful life, what does that mean? That means they have claimed the first year the capital allowances, which is IAAA, they have already claimed one time in 2007, 2008, right, and 2009, correct? They have claimed 3 years already. Can you see that? So they are left with 5 years. So the life brought forward is 5 years. Okay, they have already claimed 3 years. That's why it's 5 years. Now the next one. Furniture. And how many years useful life for furniture? 10 years. Okay. Now what is the first year they started claiming? They bought it in the year 2007. That means the first year they started claiming is YA 2008, 2009. I am now doing YA 2010. Therefore, I have 8 years useful life. Okay. Which is what you have written down here. 8. Got it? So this is how these values are derived, 5 and 8, okay? Now that's about it, okay, with regards to this. Then what's next is for you to identify the useful life with regards to the new assets. And remember, the new assets are using maximum allowances. And when it comes to maximum allowances, I'm thinking of writing it off over 1 year or 3 years. Therefore, looking at this, computer, 1 year write-off. Okay, with regards to the motor van, remember motor van, all other assets other than those few specification, 3-year write-off. So this is 3 years. Okay, so I've decided. Now what about this one? Again, this will be 3-year write-off, and that's basically what you have here. Okay, so all the additions. Okay, now after this one. Okay, after this, when you read on from the question, what happens? The question tells you that they are disposing this aircon that they have acquired here. And this is your sales proceeds. You remember, even if the examiner never asks you to do BA or BC, I must know. Whenever there is a sale, I must do this. Okay, so they are disposing of this asset. So it involves disposal. Alright, so what are we doing? We are taking out this value because the asset is no longer with the company anymore. So we are taking out, so that's why we are deducting it and transferring it into my balancing statement. You follow? So remember, your balancing statement, you have already gone through, right? What is the first sentence you'll be writing here is tax written down value before sale. Where do I get the figure from here? Okay, so you've taken this and you've inserted here and less sales proceeds, and what happens? Your tax written down value is more than the sales proceed, resulting in a balancing allowance. You okay? So that's how we have derived here. And what about your capital allowances? Capital allowances, remember in this case is only AA. Why? Even with regards to this, IA is only a one-time claim, has already been claimed. So current year, if you are claiming, but this one cannot claim, because remember, asset is no longer in use. It is already disposed. So no AA here, I'm only claiming for this. How do I claim? I simply take this, divide by the useful life. So for everything, take and divide by the useful life, and that's how you get it. Total up this will give you my capital allowances. Okay, so what is my total capital allowances? This plus this gives me this. That's it. Alright, so how do you want to present your answer is up to you, because some of them would like to write down capital allowances like this. Okay, capital allowances, this is all current year capital allowances here, and it is a balancing allowance, they will write 800, so you can write it as two different transactions, okay? Or you can total up everything and just write it as capital allowances and the total figure, which is 23733, up to you. Okay, so these are variations, both are issues, okay, in terms of presentation. Alright, now done. So this is the value. Now what I have to do is, I need to input it into my tax com. Now remember, this one has benefits both the partners, right? It has nothing to do with a single partner, and therefore it will be shared between the partners based on profit sharing ratio. Okay, so I'm going to write down, okay, as two separate items. So capital allowances, I'm writing it, okay, the total under the total column, and divide this based on their profit sharing ratio. Okay, so that's how it will reflect. So divided based on profit sharing ratio. And they have a balancing allowance of so much. Okay, so again, divided based on profit sharing ratio. Now imagine if, let's say for example, I don't have a balancing allowance, but it is a balancing charge. Then what will I do? I will now say add. Okay, add balancing charge, and again divide based on profit sharing ratio, like that. Okay. So that's it. In this case, done. You derive your subtotal. Okay. Now after this what? Okay, then you just take a look. It's going to be the same. Now after this, I'm going to add methodology, everything exactly the same. Huh? You're going to add all the other income. Now notice what are you doing here? Now you are doing based on the tax rules. Okay, so again, for this segment, what will I do? You just flip to whatever you have recorded here, and exactly what are these items is what you are actually now incorporating here. Okay, to decide whether, is it taxable or not taxable, or is it exempt? Okay, so I'm going to add your other income. Right, now you have interest. Okay, interest, and that's the only item from DBS. Now, you are expected to know, the examiner has given guidelines, that the common banks that you are already familiar with, because by way of lecture that we have actually gone through in terms of the questions which are given to you, like all these questions are given to you in the canvas, or if we've already said you must practice all those questions which are behind the text workbook, okay, the revision questions. So, banks which are mentioned either in your lecture, revision questions which are in the canvas, or if it is already there for you in your text workbook or master text guide, examiner will not say whether is it approved or not approved. You got it? Okay, so because you should have already revised, that's what the stand is, okay? And therefore you should know this is actually an approved bank. So in the question, the examiner, if he is putting anything to do with DBS, he's not going to say approved bank. So only for banks that you have not come across from your master text guide or Singapore tax workbook or your revision questions, he will indicate. Is that understood? So therefore, please be familiar. But very simple, all those banks that if ever he tests will be the common ones, Postbank. Okay? All the Singapore banks are all approved banks. In fact, most of the overseas banks are also approved banks. Okay? You will not get a shock that, wow, I've never seen this bank ever in my life. No such thing. You know what I mean? Alright? Okay. So therefore, don't worry. Okay? You must know, Postbank, all these very common. Some of you have already done the question. That's why you must do the questions at the back of the textbook. Very important. Okay? So, that's his stand. So therefore, immediately you must know, okay, yes, DBS is an approved bank. And if it is an approved bank, remember, partners, sole proprietors, employees, all of them are individuals for tax purpose. Therefore, not taxable. Okay? So the interest of 20,000 not taxable. Okay? In their hands. So you're done. Okay, done. Subtotal. Your subtotal is your SI. So you notice, whatever you have learned, remember, I cannot forget, whatever you've learned is applicable. Okay? And when we say applicable, it's applicable to all persons. Now notice, when I say person means what? It means it can be an individual or a business entity. Okay? Everybody, same rule. Okay, now done. You get your subtotal, and this subtotal is your SI. Okay? Alright, now done. Then what? Okay, then from here, you less your approved donations. if any. Now again, for donations too, he don't want to tell you in the exam question whether is it an institution of a public character. Same standing, because he says it is an open book and students are supposed to have revised all the questions at the back of each of the chapter as well as the revision questions given. And the organizations that he is going to give will be from them. You follow? So therefore, be familiar. Okay? Alright? So, if it is an approved donations, okay, so again, what is this one? I think this question already tells you approved, right? They are, okay, you see? So you see, you must be familiar. So, I'm already telling you, if you look at your Master Text Guide or Singapore Textbook Book, you will see this inside your questions at the back, and you will know that, oh, any donation to community chest or com chest, they call it shorten it to com chest, is approved. You follow? So you know already, okay, this is approved. Now once you say it is approved, what's next? At this point, you have to decide, right? Approved means what? 2.5 times. Remember, don't forget, 2.5 times the deduction. Therefore, you can get 5,000. And remember, this donation belongs to the partnership. The partnership donated it under their name. Therefore, belongs to the partners based on profit sharing ratio. Okay, so based on profit sharing ratio, this is the amount that you will record. That's it. And you calculate your AI. Now notice we say AI. Why? Because this is an individual. Remember, partners are individuals for tax purposes. Okay? So, assessable income of the partnership, so much. Okay? Alright, so this is the assessable income of the partnership. And as far as this question is concerned, that's where the question stops. That's all. Okay? So the question stops here, which is the calculation of assessable income. Now, how can the question be extended? Okay? How? Okay? Extended, this is how the examiner can actually word the question. Okay? That means he can now tell you one more part. After doing this, for one more part. Before he gives that part, he will have one more paragraph here. He will tell you, okay, some information, okay, he will give you certain information pertaining to John. Okay, let's say John. And then he will say, compute John's tax payable. See what I mean? He will never ask you to compute for both the partners. He will just ask for one. Okay? And what will he do? He will give you all the personal information pertaining to John. Like how many people, who are his family members, or he is actually maintaining his children, wife, parents, and blah, blah, blah. Okay. Then he will ask you compute the tax computation. So what will you do? Now the minute you have this, then it is back to your individual's tax computation. So remember, everything same, right? So you will stop here, and that finishes everything to do with the partnership, and then you pick up all the information starting from here. Okay, we said John, right? That means you will have to rewrite all the information, something like that. Because this one done already, now talking about John. So where do you start off? You will start off from here. From here, this will be your starting point. Okay, you will start off from here, adjusted profit, and then start from here. Okay, add other income. Now remember, this one is only from business, from the partnership. Maybe he may also have a rental income because he has his own property that he has actually acquired. You see what I mean? and he is deriving rental income from that. Okay, then you will add on. So after this, which is from business, you will write rental income received from the property. And remember what we have already said, with regards to rental income, I must know. I've also told you rental is another extremely important area. Please revise. That means you must become familiar with what are the expenses that I will be able to get as a deduction against rental income. See what I mean? Alright? Okay? So the chapter 6, chapter 6, in the very first lesson I've already identified for you. Okay? This is rental, is another income. Okay, all the write-ups are there for you in your chapter 6 of your master text guide. All these are written out for you. Remember, when in every lecture we do our summary, it's there. Go and take a look. To see what are the expenses you can actually get as a deduction. So you must become familiar. Alright? Alright? So, whatever you will record, okay, if there is a rental income that he has, then I will write down addition. And approved donation. Now this is from the partnership. He may, on his own accord, he may have also made donation. And if it is approved, okay, you will write down some more. You get his assessable income. And from here, what do? You do the individual's tax comma, less all the personal relief. See what I mean? Okay? So that's how he can actually build up the tax com into to ask you, okay? That means the examiner can ask you a question which is on individual's tax based on that. So you know what I'm trying to say. So from here, you will then start doing the tax computation, okay? Just like what you have actually done. Okay, let's do this one. Okay, like that. So once I have derived, right? Okay, remember all this we have done, okay? You derive that guy's assessable income, and then you write down all these reliefs based on the question, the CI, apply the tax rates in order to get your net tax rate. Here, let's see. Okay? That is the maximum that they can ask you with regards to a partnership question. Clear? Alright. Okay, now, because I do not want to stop halfway explanation, you can go for your break. 10 minutes, you buy whatever you want. When you come back, I'm going to start with the